for me, it's like I don't even want to take meetings with mortal founders.
This is one of the spiciest shows yet. It's my favorite show of the week. Jason Lemkin, Rory O'Driscoll, breaking down the biggest news in tech that's happened over the last 7 days.
This actually shows that sometimes Bill Gurley is wrong, because his idea is that these IPO share allocations are, quote, free money.
The amount of wealth in Silicon Valley is just unprecedented in our lifetimes. It's just gone up dramatically the last 18 months. But the horrible question in venture and startups, it is horrible. Is this a $4.5 billion exit good enough today?
A founder's optimized fundraising is a VC's below ownership target. The health of the entire US economy depends on the answer to this question. It turns out f*** off and sell your shares is not an acceptable answer. There's a little part of me that's kind of a bit sorry for Sam Altman because of where he's put himself.
Ready to go? Boys, we are back. We have some big news this week, and we're going to start with some liquidity, baby. We're going to start with Navan's IPO. So, in the theme of discussing and providing some context, Navan obviously IPO'd this week. Aurangzeb invested 150 million, returned $1 billion, and then it slightly cratered at 20%. So, I'd love to start. How did we analyze this? Take me to your thoughts.
Well, look, I'll let Rory do some deeper analysis. I'll tell you this and Dev stepping down from Mongo made me kind of wistful. It just feels like the very end of an era, the end of the SaaS 2.0 era. Dev stepping down after incredible run at Mongo. Company dipped to like 13% growth. It's now back well into the 20s. It's a good run, handing off the baton. And I kind of posted on Twitter at the end of the era, and Brian Halligan was like, yeah, a lot more are going to retire soon. Right. So that, and then for me, Navan, it just was kind of a bummer. I mean, Ariel is such a tenacious CEO. It's a great IPO. Rory's going to tell us it doesn't really matter if it was down or up. You got it done. Bill Gurley won. But it's just kind of a bummer that a company at 700 plus million in revenue growing 32%, struggles in its IPO at 5 billion. It's just, all of our portfolio companies have to do much better, right? They've all got to be Harvey or better. All of them. I'm not discouraged. I just felt wistful that like the combination of Dev retiring and Navan's stumble IPO just felt like, to me, some of the last pieces of the last era. And so be it, right? We're in the age of AI, so be it. But time to move on to the new era, boys.
Yeah, I mean, wistful. I didn't have you down as a wistful guy, but I think there is actually a lot to unpack in this. And first of all, let's start with the basic. It's a great company. It survived the near-death experience. It's a travel company, and that's a tough place to be when COVID happens. It came back from that. The investors stepped up, financed the company. The CEO stepped up, kept the company alive, and now they have, zooming out 1,000,000 miles is a great outcome. It's at the day of the IPO, 6 billion, now high 4.8, 4.9 billion market cap outcome, right? Big picture. It's great. And Jason's right. I am going to say, 2 years from now, the stuff will all be in the noise and it'll be seen as a really solid outcome, right? So so that's kind of the big picture. It's a good company. It's operating income positive, even though the financials look a bit messy. So that's the thing that counts. You can then, so probably pause there. But then if you want to talk about the specifics of the IPO, right? Look, what happened is they priced an IPO in the middle of the range and it traded down a little on the first day. And then I think on the third day, quite a lot. It's at $17 a share right now. So a pretty tough debut from its IPO to today, right? And you said something, Jason, that I actually disagree with. You said Bill Gurley would be right. Actually, this actually shows that sometimes Bill Gurley is wrong, because his idea is that these IPO share allocations are, quote, free money. You get your IPO, it always goes up, and they're leaving value on the table. This is an example of an IPO where, if you look at it from the perspective of the issuer of stock, not only did they not leave money on the table, they actually priced at what now looks like a high, right? So it's actually proof that Bill Gurley is wrong, and that the buyers of IPO stock are correctly saying, I want a discount on the good ones, because every once in a while, and you don't know when, this shit goes wrong and the stock goes down. So I want the 20% pop on Figma, that became obviously a much higher pop, in return for the risk of a 20% drop on Navan, right? So I would argue it actually is almost antithetical to what Bill's saying, which is it's free money. It shows that sometimes, I mean, most of the time it is. It skews positive. The day one pop on average makes you money, but it does show that every once in a while, for circumstances that we'll talk about in a second that are hard to predict, things just go wrong and it blows up in your face.
Can we touch on something that people don't talk about often, but it's often reported? There's like the winners and the losers, and their stakes are always said very loudly in media. You know, Orange Eve, 150 million to $1 billion, Lightspeed, 257 million to $1 billion, Andreessen's stake worth 635. A lot of people take that at face value and think that is cash in bank today for these firms. Rory and Jason, you've been through IPOs. That is not, for people that aren't aware, what does the lockup period look like? When does that turn into cash in bank? Can you just share some insight on that?
Sure. I mean, the typical lockup period will be 6 months, which means the minimum when you can start selling other than in a registered secondary is 6 months from now, at which point investors can start to sell, and maybe they'll either sell or distribute their stock. It's highly likely that it takes at least 18 months to get out of your position in a company like this, which, you know, if you have normal appreciation on average, can actually end up doing better than you priced at the IPO. But if you have, for example, the Figma thing where you have the pricing and then a huge first day pop to 140 and everyone reports this, oh my God, XYZ investor made 4 billion. And then you fast forward a year and a half, they very happily make 2 billion, but maybe it feels like a little bit of a disappointment if you're mentally spending that 4 that you thought you had for 24 hours, right? So the IPO, I mean, it's significant, but the economic significance is limited. And in fact, when we used to track exits every year, which we do, we used to track as of IPO, and then we used to call it the locked-in value 18 months later. And our mental model was that when you want to figure out how much money people actually made, look at the market cap of the IPO 18 months later, and that's probably a much closer estimate. And in some cases, it goes up massively. And obviously, in some cases, it goes down.
Yeah, I don't know what Scale's policy is, Rory. I'd be interested to learn. When I entered venture, what I was taught back in the day, right, was base case distribute for 24 months ratably after the IPO. That was that you know, if you didn't believe in the company, you might pull it forward. If you thought you had a Viva in your pocket or a Shopify, maybe Bessemer didn't, maybe you hold longer. But for sanity's sake, and also to manage float, right? Because you can only sell so much if you own a large stake. That was a rough rule. Figured it would take you, so 6 months to lock up, 24 months to distribute. That's 30 months total after the IPO before you're getting most of your carry and your LPs are getting their distribution, right? So it could be well be into 2028, 2029. Now there was almost 200 million of secondary, right? But I don't think the big guys sold any, as near as I can tell. The founders took out 50, which I like. I like that much better than in the seed round, by the way. I'd rather see them take 50 in the IPO than after demo day. I think it's a better time. But it looked like for the most part, it was just the smaller guys that sold. I could be wrong there, but that's what it looks like.
Does this impact your price sensitivity today when investing? When you see 700 million revenue, 30% growth, positive economics, 5 billion market cap, and then you see some of the prices that we're paying?
I mean, well, but the problem is the prices you're paying are for things going at a very different rate. I mean, where it should. So let's unpick that. At a minimum, your operating assumption should be that for mature companies, SaaS, transaction type, whatever, right? It's not just SaaS. It can also be non-recurring revenue companies with decent margin profile and 30% growth. We are back to 6 to 7 times NTM. Right? And if you recollect, a while back, I said that's kind of like the 10-year treasury equivalent of SaaS, right? That's what they're worth. So if you own one of these things, that's how you should think about it, what it's worth, right? And yeah, that impacts how you think about your late stage portfolio, how you think about a little extra growth is worth. But that's not directly applicable to, you know, some company doing 50 million and 5xing or doing 10 million and 10xing, right? Because, you know, those different growth rates mean it's not a like for like comparison, right? So pausing there. I mean, obviously what it says to you, I mean, again, it's the age old thing. When that 10x year on year growth rate deaccelerates to a 30% growth rate, then you'll probably trade at the same valuation multiple as the companies that are already trading at a 30% growth rate, which is 7x. In the end, if the growth rates of the new companies become much closer to the growth rates of the existings, they'll trade at the same rate. There's no magic there. Right? But right now, they're not. Right now, AI growth rates for these companies are in a very different place, as you know well, Howie.
Listen, of course, it's very interesting to see Navan at the same time as OpenAI and Anthropic raise their estimates, right? OpenAI raised it to 100 billion plus in 2027, right? I forget what it was Anthropic. We should look. They just said they way raised their estimates. So when we see this, let alone the Harveys, Harry, let alone the Harveys, when we see these, it's just, for me, it's like, I don't even want to take meetings with mortal founders. I don't even want to take them. And it's terrible, right? I mean, literally, I just did a deal with some founders I love, and it was very expensive for me. I did a deal at 50 post, with everything else in it, post, okay? That's a lot for me. And okay, for me to make 100x on that deal, okay, with dilution, and dilution in many cases is higher these days for a lot of reasons. It has to be better than Navan, for sure. Like, it has to way be better than Navan for me to make enough money on that seed deal, right? Late seed. But so, do I really believe this deal I just did is for sure going to be worth more than Navan? I don't know. And when we started, Rory, these deals would be, and I'm not being curmudgeonly or anything, but realistically, when, they were easier to see. Actually, maybe it was always hard, but now, you got to see these $10 billion exits. But if they're not utterly breaking the mold, it's hard to really believe it's going to be worth north of 10 billion, is it?
So Jason, I get you, but I've actually adopted this mindset from spending so much more time with you.
Yeah.
And I bring it to the IC, and people in my team are like, you have to turn the next card to see sometimes. And it's not obviously a $10 billion company on day one, and actually value can accrue in increments over time. And you could miss some great ones by being flippant and being like, oh, it's not a $10 billion company.
You will. It just makes, depends on your fund size. If you're doing more second and third checks and the first check is smaller, you have a lot more flexibility, right? I mean, you can. If your first check for me is a very large percent of the fund, I don't have a lot of margin for error, right? I don't have if I'm writing 4 to 5% of my fund as a first check, I don't have the other 145 million that he had in trip actions in Navan. I just don't have the other 145 million. I guess I should have developed more SPVs and opportunity funds. But for me, that first one has to work. If it doesn't have to work, then you want to play more cards today. I do think it's a good idea.
I recoil from the I don't do mortal humans. It's a bit, because I think, it sounds a little judgy there, I say it, Jason. But what I do
Judge me. Judge me.
What I do
just come closer to the mic. Just come closer to the mic and then judge me.
I think the sobering fact here is, you now have to assume that 400 million, 500 million is the threshold for an IPO. And if you say to yourself that you only want to do deals where you at least have the upside of an IPO, the IPO potential, then the bar to what a doable, successful venture-backed deal with upside has gone up, right? I mean, it's what we discussed. It's that we talked about it, fewer but bigger winners, right? So at any stage, if you're keeping the stage the same, if you were doing seed before and you're doing seed now, before this seed was an 8-year journey where 20% of them get to the end of the line, and now it's a 12-year journey, maybe only 10% of them get to the end of the line. Right. And that's just mathematically true. Now, the real question is, what do you do with that information? As Harry says, you can have one of two. You can either say, a priori, I'm only going to do that $10 billion ones, which is one approach. And the Harry's approach is more you never know up front, which are going to be the $10 billion ones. So you do them and you look at the next card and you play it out. Right. And it's a little bit, if you have optionality, you can afford to do it the Harry way. If you're picking, and most of your dollars are going in when yours are going in, Jason, then you're exactly right. At some level, even though I don't like it, I'm coming back around to now, your comment is correct. I don't like the description of mere mortal, but you do have to go into these deals looking for a higher, believable exit story, given that the exit bar's gone up. And you can't do clever little small markets that are going to top out because you're probably only looking at an M&A outcome. And then you've just intrinsically eliminated the magic pixie dust part of the alternative.
Fuck, this business has got harder.
It has. It has. And the other interesting thing to note.
Well, yeah, but also people are getting richer at the same time.
Yes.
The amount of wealth in Silicon Valley is just unprecedented in our lifetimes. It's just gone up dramatically the last 18 months.
Yes, in a very concentrated fashion. Yes.
Yeah.
No. And I think the other interesting thing just about the Navan, just to make it, is that, well, really interesting, you cited the numbers for, amazing numbers for Lightspeed, Oren, all those guys. Really interesting. To me, actually, the other thing that brought home to me is the amount of dollars that went in is that if you look at it, I think you said Lightspeed, maybe 5 or 6x, don't quote me. They did the seed and some of the seed and the A and the B, right? I'm willing to bet, to Jason's point, the multiple on those rounds must be 20 plus. Right? At least, maybe 30 plus, right? But what you're seeing is instead of being a $20 million investment, getting diluted down, right? But still getting a magnificent 30x return, you're following that 20 up front with 200 more on the mid and late stage rounds. Your overall blended return is a 6x, but it's a 6x on a lot of money. And you probably have some early stage dollars that are 20x and some late stage dollars that might even be a loss, given the last round priced at $9 billion. So, and overall, obviously, it's a wildly successful strategy. It just brings home again, you're diluting your early return, but you're doing that because it goes back to what we said last week. When you have one of those winners from your early fund and you have the amount of dollars these folks are managing, you just have to put every dollar you can into your winner. And they did it here and it worked successfully. And even more impressive that Oren Zev did it with, a smaller solo fund and ended up with 150 via, I assume, a bunch of SPVs into his biggest deal, and good on him.
And across many different vehicles, which is awesome to see for Oren. I mean, Lightspeed was 257 to $1 billion, so it's just under a 4x blended.
Which is so funny.
I think the horrible question, maybe not to spend all the time, but the horrible question in venture and startups, it is horrible. Is this a $4.5 billion exit good enough today? It's a horrible thing to say, but if we're talking about VC and inside baseball, it's a bona fide question. Is it good enough today? $4.5 billion.
It is. They took they took 200.
I mean, no, it's not. If your fund size is $1.5 billion or $2 billion, it's a third of the fund.
No. Yeah. I mean, it's still a third of the fund, though. I mean, look, you're not going to have, guys.
So much work. I only got a third of the way to 1x, Rory.
Yeah, but the point is, those are different.
Good God. I spent 12 years with these amazing founders. We had a $4.5 billion X, and I only got a third of the way to 1x. You never told me this was such a bad job when I joined the fund. This is the worst. I mean, the perks are great. The dinners are fabulous. Tech Week was so fun, but this a third of 1x? It's the worst job ever.
But yeah, because you're looking at it through your lens of a seed stage investor where you want your best deal to return the fund, right? The truth is, as you start putting these kind of late stage, as you start doing look, we just said it. The early stage round, let's decide your first dollars in on a deal like this was probably a 20x plus. Your first round in probably returned the early stage fund. But then instead of just stopping there, you decided, you being whomever you are, to raise a late stage growth fund. And you're not going to get without doing massive deal concentration, you're not going to get a late stage investment quote returning the fund. It's not a thing. Because if you're doing 20 deals, and evenly, that's, what's that, 5% each? Unless you get a 20x, which you typically don't get in a late stage deal, you're not going to return the fund. So these guys aren't sitting there going, they might be saying on my $300, $500 million early stage fund, one deal can make it happen. But on the late stage fund, they're saying we got $4 billion. We're going to put it to work. The average good deal will be a 3 to 5x. We'll have a low loss ratio. And over time, we'll get our, 2.5x net. It's not their small numbers of big hits business. It's a very different business. It's moving money at scale. And the example of Navan is they're doing it successfully. I mean, look, the embedded risk on that business is price compression. And you're seeing a little bit of it here, right? In the sense of that $9 billion round lost money. Some of the people who bought at the IPO lost money, so the risk you're running is, not catastrophic wipeout as much as just you underwrite a 6x and now the thing is trading at a 5x and suddenly your return is down 30%.
So for those that came in at the 9 billion price, are they down 50%?
I believe so, because I think it boils down to, I read it as they convert 1-to-1. I eyeballed the prospectus. But yeah, a fair amount. I mean, again, remember, that's only, I'm going to say this again, that's only the price today. If you want to go back to 2012, you can find a whole bunch of dumb articles about how Facebook is a crap company because the IPO and the stock price went down. Turns out it was a 10x company from there at least, right? So it's a point in time. But you're right. As of now, the last private round and buyers who bought in the IPO are down on the month. It's a horrible, it's a horrible short-term IRR.
Jason, sometimes I think Rory just sits back and thinks, I'm so lucky to do this show with Harry and Jason.
I think that all the time for so many reasons.
There we go. Listen, Jason, you mentioned Harvey. Harvey raises $150 million, $8 billion valuation, led by our dear friends at Andreessen. Now, I actually tweeted about us talking about this, and a little insider at Harvey, one of their not so quiet investors, shared with me that they're at 150 million in ARR. Their DAU to MAU ratio is 40%, which I thought was astounding. Like, usage-wise,
I don't think it's outstanding, but keep going.
GRR, 98%, NDR, 170%. How do we think about this latest round for Harvey?
Sorry, what's the growth rate? That was at...
They didn't share that.
Okay,
one.
150, let's go 150 in revenue, right? Outstanding NRR, people, they're really buying more, 170. No one's leaving, GRR of 98%, right? And DAO MAUs, you're impressed, but it just means they're logging in every day to use a legal tool. That's what I get. That's table stakes to me. They use it every day, right? But it'd be a flag if they didn't, right? Hold on. Let me put it in the SaaStr AI, 8 billion, the SaaStr AI valuation calculator says. What did it go out at?
8 billion.
If it's 400 forward revenue, that's 20x.
Agreed. That's
what it is. 400 next year. They're 400 ARR. That's what they're predicting. 400 ARR, not GAAP. 400 ARR. That's my guess.
And 150 million raise for Andreessen coming in. This is like a dilution wise, very small for the company.
I love these rounds of like getting 9 figures for 1 or 2% of the company. Honestly, it sounds like I'm being facetious. I do love these as a seed investor. They're great. There's no dilution. There's no effective dilution to these rounds. To Harry's point, they're great, right? Now there may be a little pressure on the exit, but there's no dilution.
They've executed really well in a core domain where LLMs were going to have a profound impact. I mean, what's fun about it is up until now, legal had been a pretty barren place. I mean, in terms of software sales, you have companies like Filevine and Clio that have, built decent sized businesses, but haven't yet gone public. And not a lot has happened in legal. I think LLMs, by virtue of the fact that they manipulate language, which arguably is exactly the definition of what a lawyer does, perfect fit. So, and I think they've done a great job. They've established kind of market presence in the AM law very quickly. They established a brand quickly. They've executed well. The growth is clearly there. I think when you start thinking, what you're really asking, does quote unquote 8 billion make sense, right? What that really boils down to is a TAM question. Now, they're clearly in the lead. Lagoa is clearly second, focused on lawyers, corporate law practices. The question is that the constraint there will be the TAM size, right? How big is the TAM? How many law firms, how much spend per lawyer? There's 1 million lawyers in America, half roughly in-house, half roughly, external. Yeah. Does the math support a $24 billion 3x from here company? And going back to what we said earlier, 24 billion. Let's assume that in the end it's a 30% growth company like everyone else and it's a 7x times. That implies a $3 billion revenue line. Is there a $3 billion software business selling to corporate law? Not crazy. Westlaw is bigger, selling information, but that's the kind of scale you have to have. You basically have to be such a big automation tool for these lawyers that they're willing to spend, equivalent dollars, thousands of dollars per year in subscription to make the math work. So it's a time we're clearly going to be number one in that market. And the only question, if you were underwriting that at 8 billion is this a 1 billion a year spend or a 3 billion a year spend? If it's a 3 billion a year spend, maybe you get there.
Totally agree. I think it goes back to your statement that you said episodes ago, which is like the core determinant of our success in venture with the AI transition is, will we see the transition from software spend to human labor spend? Or sorry, from human labor spend to software spend. And I think that's the damn question.
You're totally right. Because selling software to lawyers is a particularly shitty business. It's a more constrained business. You've got to do more. You've got to help more. You've got to speed them up. And it's not all or nothing, by the way. This kind of, I've been seeing a lot of good literature on it. It's not about automating people, it's about automating tasks. You've got to make them a lot more efficient, and they got to be able to track that. And if that happens, then it all makes sense.
We mentioned liking these rounds for their low dilutive characteristic or nature. There was a good piece from The Information this week about Benchmark lowering their ownership requirements, and McCall being the example. They only have 10% where they always normally needed 20%. We always knew this with Benchmark. In general, has AI seen a reduction in ownership across the board for this generation of venture?
Every deal I've been in, my God, ownership is attacked at a level I've never seen. And so that's my conceit investing today. Is giving up on that, right? Is for me, I feel like I can only make money if I own double digits of 2 winners per fund. I feel like that mathematically, that's the only way I can make money. And the last 3 investments I've done are in the 6 to 8% range, even though that's my rule. But what am I going to do? Not do the deal? We also know that's the dumbest thing of all time, right? So I'm literally going to write my LP report up in a couple weeks. I'm going to say my resolution for 2026 is to get my ownership up. We'll see how I do against my resolution, but that's my main resolution. It's like, you can do it a few times, but if you do it every time, it's tough. But I don't know what you do in this world. If the companies are capital efficient, they don't need you. It's complicated. You don't really, in a hot company, you don't really control the die, to use kind of like lame VC terminology. You don't control the die.
Jason, why didn't you raise 125 and then you can have more ownership?
No, that's that's a different mistake. But this is really this is all there is.
Agreed.
Yeah, you could like, if there's a co-investor, I guess you could be a total jerk and, say, it's me or nothing. I've tried that once in my whole career. It's just not my vibe. It backfired on me. Of course, that company wasn't that successful, but if you want to be somewhat founder-centric, the best thing I know how to do is say, listen, I just need to be the largest investor and let me invest the maximum I can in the round. And that's as far as I go. If you're not willing to put the extra dollar into the deal, don't do it for sure. But if they're selling 10%, it's hard to buy more than 8%. It's just going to be hard.
Yeah, because I think it's multi-causation. So, I mean, I'm breaking apart your question, Harry. The one question is, are VCs getting less on average in these deals? And then the second part of your question was, quote, because of AI, which we're going to agree is a meaningless phrase and try and fix it later. So on the first, I think they probably are. Right? I think there's no doubt in my mind. I mean, I think it is harder to get 20% ownership for the super early stage funds. It's harder at our stage. Our target would be 10 to 11% on average A or, probably late A or B, some earlier, some later than that. It's harder across the board. There's no doubt that that's the case, right? And, we can take Mercer as benchmark as a premier firm. And I will be validated again. As I said, reports of their death were greatly exaggerated. That sounds like an amazing 21 fund they've reported. But yeah, that's an amazing firm courting a great company and only able to get 10%. As Jason said, what are you going to do? If they only need to sell 10% of the company to fund their needs, right? Then, you're only going to get maximum 10. And you can either decide not to play, which would have been a very dumb decision, or you can decide take 10% and keep going. Right. Now, it's interesting. Why is this happening? There's a bunch of different reasons, because you can't say because they're capital efficient, because let's be frank, some of these AI companies are the least capital efficient companies in the history of humanity. Right? Mercer, pretty capital efficient. OpenAI, planning to spend more money than we thought existed in most entire continents. And they're not stopping yet. So it's not capital efficiency, right? On the capital efficient ones, if you're so capital efficient that you don't need to raise a lot, then you become hot very quickly. Then you've got leverage as a founder. On the other extreme, if you're so capital inefficient that you need to raise $13 billion, then it turns out that no matter how much you put in, if you put in 100 million, you still only have a couple of points, right? Both of those, interestingly enough, will be pretty good deals, right? Which actually and I'm doing this in real time, makes you realize that your mental rules of thumb have been smashed to pieces, right? You can only get there's a situation where you're going to get 10% because it's capital efficient, and there's a situation where you only get 1% because it's capital inefficient, and both of them has amazing returns. So that's just the way it be, right? And I think part of it, so maybe that's the aha. There's a compendium. I mean, logically, you'd say to yourself, if it's a continuum, there must be some sweet spot in the middle where they needed to get 20%, but then they were capital efficient enough so you make out like a bandit. And I'm sure those companies exist too. But I think that's the aha. It's a continuum here. It's a wider continuum than we've seen, perhaps, maybe not in the early internet as I think about it aloud, but then we've seen definitely in the SaaS era in the last 10 years, right? Companies, as you say, being able to get to hundreds of millions of dollars on 10 or 20 million bucks, and then other companies needing, 2 or 3 billion just to get a model out the door, right? Neither of them results in a standard venture ownership position.
Yeah, but just maybe not to press on it too much. But I do think when I was reading the Iconic's latest report, what they said is when you look at all the top quartile companies in their extended portfolio, or not all that they surveyed, yes, they burn a lot of cash, but the burn multiples of their top companies are much lower because they're growing so quickly. So even if you burn a lot, even if you ultimately raise a lot, that if your burn ratio, if burn multiple is low, you're able to sequence capital differently. Like you could listen, hold off. I'm going to do just 10% now, and then I'll do 5, and then at 8 billion, I'll do 1.2. You may raise a lot, but a high, if your burn multiple is low, even if it takes a significant amount of cash, it lets you optimize how you sequence fundraising.
Agreed. And remember, the words optimize how you sequence fundraising as an entrepreneur. The inverse of that is thou shalt not be optimized as a VC. A founder's optimized fundraising is a VC's below ownership target. You're exactly right.
I think that's right.
If Mercer had needed 40 million to get rolling, then RedRock would own 20%. If they only need 20 million, then there you are, right? And you're right. They can increment, raise another 2 rounds. And even the extraordinarily ambitious, the other extreme, the extraordinarily ambitious foundation models, not the new ones today, but, early Anthropic and early OpenAI were able to do incremental fundraisings in a way that, as you say, avoided significant dilution.
I mean, even, and I say it with huge respect, even Y Combinator is structured this way, right? Y Combinator's advice for most companies is to raise a maximum of 10% before, during, and after demo day. It's very thoughtful advice. It's very structured. Yeah, it's biased to helping YC, but it's also saying, listen, we've run the numbers. Most of you will do better selling 10% at demo day and another 10% at 3 to 5 times the valuation. Not just in terms of overall capital raise. It's not just valuation. It's effectiveness. And so they've institutionalized this low ownership, right? It's always been true, but I think it's been productized the last couple of years. 10% at demo day, right? And if you want to do 4% from angels and friends, that's 6% left for a VC. Maybe you get 5 or 6%. Unless you way overbid and basically do 2 rounds at once. That's how you get more ownership in YC. You do 2 rounds at once.
I absolutely agree with you. I see 3 on 30 instituted so well by YC as the de facto round. And again, there's huge respect to them. It's good for them and it can be good for founders, but it's a challenge for us to navigate.
I'm not even criticizing. It's just you asked about low ownership. This is institutionalizing. YC's always been about low ownership with VCs, and I get it. But now it's been institutionalized very effectively. 3 on 30, 4 on 40, 2.5 on 25. That just, you got to get single digits.
This is where I was just thinking, just do a world of Roger Ehrenberg, though. We had him on the show. The world of high ownerships, go where others aren't, get 20% in actually reasonably priced assets. Let's not do AI dictation tools from YC and get 4%.
If you like, Harry, did you see that Anthropic is now projecting $70 billion in revenue in 2028? I'd rather have a piece of that.
Pretty good.
I'd rather have a little piece of that.
And yeah, I mean,
did you guys see Sam Altman's response to Brad Gerstner? What did you think of that? I was intrigued because it was quite a retort publicly.
It's a totally legitimate, entirely obvious question. Hey, you're doing 12 billion in revenue.
You're planning to buy, how are you going to fund $1 trillion in CapEx over the next 5 years? And, I'm sure there's an articulate answer you could have made. You're right. The answer, if you want to sell your shares, sell your shares. It was a little snarky, probably because you're tired. You're 1 hour, you're halfway through a 1 hour interview. You do 1 million of these all the time. I believe you just have a baby in the house. You're tired. You're grumpy, and you just make a snarky answer. Oh, well, I'm not gonna, I think maybe to say it this way, the question is substantively important. You didn't learn anything about the plan to fund the $1 trillion from the answer. You learned a little bit about the persona of the person in a bad moment, but everyone has bad moments, right? If you want to know more about Sam Altman, there's 53 pages of testimony now on the internet. You can figure out, you can all come to your own judgment on that. I think the question itself is totally legitimate. It's going to be asked in increasing, there's a story that can justify it. It's all about revenue traction. If you get to 100 billion, you can support, 60, 70 billion of CapEx. But it's a totally legitimate question.
He did say, didn't he say to Sam, if you want to sell your shares, I'll find someone for you in 60?
Yes.
A founder's only said that to me once in my career. I never said a critical word ever again. When I was said to me, that was a teaching moment for me. I'm like, okay, I crossed the line. Like I didn't realize I did. I never said a critical word ever again when I was told there's a market for you. Just let me know how much you want to sell, Lemkin.
But no, I'm not kind of doing the, oh, damn you for saying that. We all have bad moments, right? But it is kind of a bullshit answer, right? And if you if that happened to me in a board meeting, if I was a board member and CEO, you might say to yourself, oh, I want to find, if it's a legitimate company ending question, notice you have to have an answer to this question, because I'll step back to it, because not just the health of your company, but bizarrely enough, the health of the entire US economy depends on the answer to this question. It turns out fuck off and sell your shares is not an acceptable answer at scale. And if I'd been a board member at this, you said to yourself, okay, maybe I shouldn't have ambushed him in public. Maybe I should have said, hey, look, I just want to spend some time. You give your CEO the courtesy of not feeling ambushed. You maybe don't do it in a visible place, but you do have it. If you're on the board of a company that's planning to spend $1 trillion, whatever it is, I can never keep up now, and you only have 12 billion in revenue, it's a totally appropriate board level question to say, how are we going to do this? So
I don't know anymore. I don't know if that's true. As silly as it sounds.
It is beyond silly.
I think there is so much fear among VCs of getting out of step with the most successful founders. There's so much fear. And you guys are going to disagree with me, but I see it all across my portfolio. The better the company is doing, the more everyone's a grin fracker. There's just never a critical word said.
Now you've poked the bear. I have a company that's going shit, and it's going to shit, like literally Buster's balls. The board members will not intervene in any way to protect the shareholders because of the bad NPS that will come from damaging that founder relationship. That, to me, is one of the most egregious escapes from fiduciary duty. And this is some of the most reputable investors. Harry,
but you're agreeing with me, right?
I'm agreeing with you 100%.
Yeah, you're seeing the same behavior, right? Yeah. I would listen. OpenAI has had an interesting history, but if it were normal startup with the VCs we work with, and they had to come up with 1.2 trillion, I think everyone would be saying, "Sounds good, Sam. Sounds good, Sam. Keep going. Good month."
Fortunately, and again, I don't know the man, but I've just been very impressed with. I don't get the impression that Brett Taylor is a yes man. Right? At one point, I'm not sure if he's still on the board. I should know. Larry Summers was on the board, and Larry Summers is many things, but not a yes man. He might be off now, which would be a shame because he would be worth being on the board with just to hear him speak. Right? I think he's a very smart man. But stepping back a level, there's a little part of me that's kind of a bit sorry for Sam Altman because of where he's put himself. Basically, every public analyst will say, right, that, he did what he had to do to raise this kind of money, but everyone covering the public markets will say the only thing between us and a 30% promote is the AI CapEx boom, right? And he is the poster child of the AI CapEx boom, right? And And if the AI capex boom unravels and the world and media is looking for a villain to throw rocks at, it ain't going to be a big search. Actually, genuine comment here. If this thing starts to slow down, it'll just get real hard real fast. And I think if you're on a board member in that, you actually owe it to your CEO to say, hey, dude, how are we thinking about this? Do we have good answers? Right? We can't just be glib. I hope that in the boardroom, Brett Taylor and those guys are sitting down and saying, okay, what's the cash flow numbers that says we can honor all our commitments? What are the cash flow numbers that say maybe we can't honor 2029 and 30, but we can do the others? How are we going to do all this? Right? Because when someone invents numbers at the $5-10 million level and they're wrong, they disappear without a trace. When you invent false numbers at the trillion, when you invent numbers that are wildly over optimistic at the $1 trillion level, and if it unravels, you just become the poster child in every economic history for the next 200 years of the great AI crash of 2026. It's a pretty shitty place to be. And one of the things we've talked about on the past is, the job of the board, to your point, guys, is not to be a rah-rah. It's actually to help the CEO avoid things. I often look back in some of these young founders, and we talked about this. Yeah, they were wrong. But the older board members who should have had more experience were even, in one sense, they are less legally culpable, but morally they're culpable by not saying, hey, dude, are you thinking this through? Do we really have an audit, Sam Bankman? Do we really know where the money is? Do we really know where the customers are, Charlie, whatever, Javis, or whatever her name is? You're as a board member meant to provide the guardrails. So I think when I look at this one, I go, I hope someone's providing really good guardrails. Because if it hits, it'll hit hard.
A lot of founders feel like VCs should just be their allies, period. And period. That's your job, is to support me. That's your effing job. And some like the critical feedback, but I think it's far fewer today than you might think. Your job, and if you're not supportive, you're a problem for me. You're making my job harder. I think that's how founders feel, and I think that's how Sam felt, was my guess. The second thing that's just interesting to watch, because I do think Sam's pretty transparent, is I think it did show there is some stress around raising 1.1 trillion. I mean, not around raising it. He's committed to it, about generating it. If there was no stress, it wouldn't have been. He wouldn't have poked the bear. Right. So I don't think it's actually a big deal. I do think they'll work around it, scale it back, but it did show there's some stress around hitting the 1.1 trillion in, it's not even revenue, right? It's got to be gross profit at 50% margin. So they got to do 2.2 trillion or more to pay for it. Or maybe I'm getting it wrong, but they've got to certainly do more than 1.1 trillion to pay off their capital commits.
Yeah. I can't believe I'm saying this. It's only cumulative, so it might be a little less. But yes, it's in the many hundreds of billions of dollars a year in a world where today only Amazon, there's a couple of companies. Google does 100 billion in a quarter. So does Amazon. You got to be at that scale. And, 300-400 billion a year. Yeah, you're somebody. You can pay for these things. It's a real number.
You mentioned Amazon. Amazon crushed this quarter, plus 20%. AI shopping assistant Rufus, additional 10 billion in sales. Things looking up for Amazon. They obviously have their ownership in Anthropic, which I think is at 7.5%. How do we feel about the state of Amazon today? Where they sit considering last quarter? How do we feel?
The overall growth rate was, I think, 11 or something. But the real point is Amazon Web Services, their cloud business grew at 20%. The story had been they were the dominant provider pre-AI. They felt they'd slip versus Google and Microsoft in the AI world. And in fact, in terms of growth rate, they still have. Google and Microsoft were both in the mid-high 30s. But AWS kind of came back from, I want to say, 13% to 20%. So the story was, we're relevant too. We're not irrelevant in the land of AI. And the stock popped. And I think the real takeaway from here is, and this is the counter argument to all the cynical, it's a bubble people. It would appear, and Microsoft said the same thing, that demand for these products is still exploding, right? Yeah. If you have it, you can sell it. Right. And at some point, maybe that won't be the case. I have my concerns. But right now, the objective facts on the ground are, Microsoft was saying, my biggest problem is I can't build data centers, so I'm capacity constrained. Amazon was saying, my growth rate is up. Interestingly, they just signed a deal with OpenAI, because everybody signs a deal with OpenAI, and to sell them more compute. So they clearly found some capacity for that. But overall, the story was, continue high demand for compute. And if you're selling compute, stocks go up.
That was the takeaway. I don't have a sense of the consumer business and the Rufus shopping agent. I believe it's in limited beta. I haven't run into it. Have you? And the compute story was strong across the board. That was the aha, right? You know, the people who want to articulate it's all going to go wrong story. Right now, you have to still make that story prospectively and say it'll go wrong in the future. What you can say is it's going wrong now because the demand was still there.
But to me, it's making a press release that says you're now the number 5 or number 6 partner to OpenAI for NVIDIA GPUs is not that impressive. Like, it's just, you're behind Microsoft, you're behind Oracle, you're behind Google, you're behind, and so it's interesting that they found some GPUs in the closet. I'm not speaking literally, but I don't actually think it means much to be late to the party to sell. It may mean a lot over time. Don't get me wrong, but I think today it feels like there is a lot of AI performance theater today. There's real incredible growth. There's growth in our retirement funds across the country, but there's still a lot of theater. There's a lot of folks who are doing a lot of work in AI, not seeing huge benefits. So this felt partly theatrical to me, but it's okay. I'm in favor of keeping the ball moving when you don't have all the answers.
That's very cynical, Jason.
It doesn't rank them. I mean, literally,
I think
they're like, okay, we called the CoreWeave guys. We called Nebius. We called Microsoft, Google, and Oracle. We even called Benioff in case he had some GPUs or TPUs hanging around.
Yeah, no, I think that
Amazon found some.
Yeah, I think the stock popped more because of the objective fact that the actual revenue growth grew. Then you're right, than the OpenAI deal. But you know, it's almost, while you are right that it's not huge compared to the 250 billion from Microsoft or the 300 billion from Oracle or the 400 billion for Broadcom, it is still better than not having one, because now at least we can say they don't have one. So tick, done.
It is, but it's tough from AWS having really created the category, right, of cloud providers and being what we all grew up on. It's a major come down to be not even to be above the fold on the leaderboard.
I think that's a different statement and totally correct. You're exactly right. 5 years ago, AWS dominated cloud compute. Now they don't, right? Because cloud compute evolved from being simple compute to being AI-centric computing, and they didn't evolve fast enough with it, and they let a whole bunch of people into their little oligopoly. Yeah. So zoom out a million miles. That's a bummer. If they knew then what they knew now, I think in 2019, they would have bought a lot more GPUs and been a lot more aggressive.
And yeah, 20% growth also is a lot, right, at this scale. Absolutely. But Shopify, which is a competitor, right, on the other side of the house, it blew it out. 32% revenue growth this quarter, 32% GMV growth, which is a close analog to Amazon. I mean, Shopify is reaccelerating at 8 digits of revenue, which is pretty crazy. So, I mean, kudos to Amazon, but it's also lucky that both of its core product lines are getting just a general boost, right? There's a lot of tailwinds going on here.
Jason, I know Rory won't answer this one. Given what you just said there about them not being above the fold and they're losing market share in one of their core markets, which they used to own, and then considering the 20% pop, how do they sit in terms of being underpriced versus overpriced?
Look, at some level, this isn't my strength, right? I don't do a lot of public equity investments. Since you asked me, what I do think about as a B2B guy, right, is I do think that for the moment, Google is underappreciated and Amazon is overappreciated. Google was slow to AI. Google had to bring Sergey Brin out of jet skiing and windsurfing and retirement to whip the troops into shape. But Google's really good now at all levels, right? It's really good at consumer AI. It's really good in searches Search is growing for Google again. The TPUs are good. It's a good partner. And it's the only one other than NVIDIA making real money. So I feel like Google is underappreciated, and it has the application layer. It has all the applications, so many that we use. Amazon has none of the application layer, right? It has very little at the hardware layer. It has a niche search, which is incredibly powerful, but only used for e-commerce. In a way, it just doesn't have as much going for it.
To be fair to Google, I mean, you used the word underappreciated. I think the stock has appreciated very nicely. I mean, the catastrophists at the start of the year were, oh my God, it's awful. And I think it's up 53% from there. I'll admit it. In Q1, we talked a little bit about the companies, and I was positive on Google. And I admit it, and Harry knows this. I was retrospect, I thought about it felt so contrarian that I even said, please don't lead with that on the highlights, because I felt a little stupid. And you fast forward 2 quarters, it's turned out to be broadly correct that they have the key ingredients and a place to put them and the ability to monetize them. And Facebook's missing that last key element, right? I still think, to your point, Jason, what AWS, I still think at some macro zoom out level, if you had a monopoly in search and now you've gone to having ChatGPT as a de facto competitor, you'd still be better off if it hadn't happened. Right? You just can't deny it. Like, it was a really good gig when you had this monopoly, but so you're not better, you know, you wish it hadn't happened, but once it has happened, what you got to give them credit for is getting almost everything done to be able to play in the new world. They had the key ingredients. It took them a while to put it together, but now they have all the boxes. You'd still prefer not to have to do any of this shit and just, you know, optimize your 10 links from now until the end of human time, right? Versus having to compete, but they're competing well.
In terms of playing in the new world, it was bad week for Meta. I'm one big ass Meta shareholder. Never argue with Zuck, or don't doubt Zuck. But wow, the $15 billion fine, and then the reaction to their commitment to CapEx moving into 2026 and the enormous spend that they continue to do and will continue to do. I mean, down double digits. How do we think about how they fare in the new world?
I think it's easy because the core business performed really well. Let's start with that. The core business, I think, grew 20%. You know, despite, yes, some usage being down, it's kicking off cash. Yeah, it's a great business, right? The market is just entirely, and we said this 6 months ago, entirely correctly saying, dude, you have this wonderful business, and then you're taking the entire cash flow and you're building this AI stuff. And unlike Google, Microsoft, or let's say Google and Microsoft or Amazon, you don't have an enterprise business to sell this shit to. And unlike ChatGPT, you don't yet have an obvious AI forward app that's going to give you a lot more time. That going to give you a lot more consumer engagement. So you're basically spending $70 billion a year, but with no revenue attached. What the hell? Right? And, you know, that Mr. Zuckerberg's answer appears to be, I think it's relevant to be in this space. Thank you for your opinion. I refer you to the Artisan Corporation. I control this company. Have a nice day. Right? So the market's just saying, hey, you're doing the thing you did in 21, 22, putting a whole bunch of capex into something that might not work. And that's why the shares are slightly down, despite objectively pretty good performance. It's entirely rational. They're saying, I don't know why you're making this spend. And he's saying, that's why I'm a founder. I personally don't get it either, but, you know, I didn't build Facebook. If he's got a plan for it, we'll see. Doesn't appear to be the most efficient way to spend $70 billion, as judged from the amount of infighting, but we'll see.
One that made me happy was Twilio. Twilio bounced 20% after beating expectations. Question being, when you look at that and you look at that generation of companies, your Dropboxes, your Boxes, maybe your underloved, underappreciated companies, are we going to see a series of bounce backs on better than expected results, do we think?
If you undervalue, then you perform reasonably well. I mean, what happened is let's step back. Twilio, $20 billion company, doing 4 or 5 billion a year, valued at 4 or 5 times revenues. You know, as you say, had a decent quarter, bounced 15%. I think, yeah, revenue growth up 15%, had a nice stock bounce. It's still in a bounded universe. The zoom out point is this. These companies, they're in a much more bounded world now. They might grow 15%, they might grow 5%, they might trade at 6 times revenues, they might trade at 4 times revenues. You know, if you look at the stock chart, the area of magic is gone and now they're just perfectly good $20 billion market cap companies kicking off cash. Really strong cash performance. That's what successful, mature companies look like. They'll be valued accordingly. That's the good news. And yeah, the bad news is, as you look at the AI first universe that exists, they're not really playing in that to any degree of significance. In a world where you're cash flow positive and trading at 4 or 5 times, you can feel really good about yourself. And then you look up and realize, oh my God, Palantir is trading at 123 times revenues. And it's cash flow positive. You know, they're not in that ballpark. They're not in that game. So yeah, that's what a mature business with mid-level growth prospects look like.
My take was a little bit different. My take, so Twilio goes from single digit growth to 15%. That's still significant reacceleration. We talked about Dev stepping down at Mongo. He went from 13% growth 5 quarters ago to 24%, 13 to 24, right? That's almost doubling your growth rate. And here's my point from both of these. It's now, we're heading into 2026. you better have gotten a few nickels out of the AI expenditures, all the AI dollars. This is not new, guys. This is what 60% of the growth of our GDP. You can't miss AI. And so Twilio said its voice AI customers are a huge part of that reacceleration. It says voice AI is up 60%. We all know 1 million companies using voice AI, right? It said its top 10 voice AI startups are up 10x. The same AI is fueling the number of databases we use. Now, sometimes we use Supabase or Neon if we're vibing, but a lot of folks use Mongo. So not to be the only guy in the board meeting that says something, but going into next year, you sure better have seen reacceleration because of AI, because there's so much money there. You got none of it, guys. You had 18 months to not launch a single feature, tap into a single trend to reaccelerate. Now, I'm not expecting you went from 30 to 300% this quarter, but if you're not growing faster at the end of 2025 than the start, as a founder, I give you an F minus. There's so much money and you don't have to be Harvey to get a little piece of it. Twilio and Mongo and Cloudflare and tons of folks have a little piece of it, a little piece of that massive pie.
I think that's totally fair. And that was well put, because I would almost amend what I said. They're not the AI native exploding 2x year on year, but what you're saying is correct. There's a big point spread between, we'll talk about some of these companies in a second, having no AI magic pixie dust and getting taken private for 3 times run rate revenues to be, destroyed by the PE machine, and getting just enough AI pixie dust and lift to get that growth rate in the mid 20s plus, like Mongo, see some reacceleration. And we've just agreed from the Navan comp, you're still only going to trade at 7 times revenues, but it's a damn sight better. 6 or 7 times revenues, and some kind of forward story is a big point spread from 3 times revenues and being sold to PE. And that's the story we're actually articulating to a lot of our private companies. I get, you can't go from the $100 million revenue to just being Harvey. You're not. But you better find a way to be relevant. And I like your expression, Jason, the age of AI. You better find a way to matter in this world and co-attach to the spend. And even if it only takes you 10 basis points up from 15 to 25, that's a night and day difference in terms of your relevance and viability. And actually, because I always like to come back from the publics where I think we have opinions, but maybe it's not our day job, to the deals we all work with where it is our day job. And I think you're exactly right, Jason. That is the message for any of your companies that were pre-2021, that are pre-GPT companies. Maybe you can't make yourself into the next Harvey or the next OpenAI, but by God, you better co-attach to that spend, because it's the only game in town. I think you're totally right. And I think you should be preaching that to all your guys as we come into the end of the year and looking at 26.
And look, sometimes it's luck. Like the CEO of WorkOS, Michael, he was posting, I think they went from, I'm gonna get these numbers wrong, but something like 20 to 40 in 5 months. Okay. And he's been working hard for years on WorkOS to be an OAuth and authentication layer but all the AI guys used them. So seeing insane growth. We've all seen portfolio companies and sometimes you got to make your own luck, but we've had 18 months, get a little bit of the Harvey, so there's just, you got to find it. And it's like, it's at the edge of too late, not because there's not time. I actually think there's plenty of time for startups. It's because your team isn't good enough. If you haven't gotten a boost this year from AI, fire half your team right before the holidays. Give them a turkey and 3 months of severance, but they failed. Your team is not good enough. They had 18 months to ship a product that mattered in this world. Where's your agent? Where's your reacceleration? F. No more excuses after Thanksgiving. But the irony is it's early. At the same time, what we're all learning now, we feel like it's late with all the stuff we talked about, the cursors and replets and levels and Sierras, but it's actually so early in so many categories, right?
It's just 3 years since ChatGPT shipped.
Yeah, but you got nothing. You did not reaccelerate this year. Fire yourself or half your team. Take your choice. Fire yourself or half your team at the end of this year. Don't keep those folks that don't have the answers around. You're better off just not having them. You had time, right? And if we want to be like, I almost hesitate to say this. If we go back to the publics, because we love this folks, if we want to be critical, HubSpot and Salesforce got to deliver in 2026 because they're in play. They have the AI things. They ship the products, but they haven't seen the bump that Datadog and Twilio and Mongo have. And maybe that's okay. They're not at the infrastructure layer. Maybe it takes longer, but But if I were Mark or Yamini, I would fire half my team if I don't see real growth from that by middle of next year. I just fire half of them. You got the wrong people. There's 2,000 people building Agentforce, and we've deployed it. It's pretty good. It's quite good. It's very competitive with any other agent you're going to buy. Time to monetize it in 2026. It works. It's a good product. It's not just smoke and mirrors. It's really good. So your team, maybe some of those folks that have been hanging around for a decade, maybe they're not the right people going forward. I don't know.
Sometimes when Jason is cruel and harsh, I disagree. And then sometimes I listen and I go, he's absolutely right. This is one of the latter ones. I mightn't say it as harshly, but I think you're exactly right, Jason. If you're not on this train now, you're just not going to be relevant, and you will be sold for 3 times run rate revenues to a PE firm who will smush you in with something else, never to be seen again. And you have your chance. And it's raining money in this space, and you need to navigate your product towards it. And I think that's probably pretty common advice across, as I think about our portfolio. And, all those, we talk about them a lot, and that's why the Navan thing was so good. All these companies that are doing 100 to 200 to 300 with, sluggish 20% plus or minus growth rates, they need to figure out how to co-attach and re-expand, or eventually you're going to get tired, the VCs are going to get tired, your team's going to get tired, and something's going to just not work out.
The one thing I got a little bit, I get a lot of things wrong, right? Is, it took me a while to see the data to believe that software companies could really capture dollars from replacing humans for real. Okay. It's not that I didn't believe it. It's just so much of the stuff was VCs talking out of their rears, making stuff up, talking about how every human's going to be replaced with an agent when the software wasn't very good. It just wasn't good. It was hard. It was a great dream. And when Vinod says it, I believe it. But when most of the rest of the VCs say it, I think they're just water cooler talk. But now we're really seeing it. Agents are better than mediocre humans. So you better be tapping into that revenue too. They're better than mediocre humans. So get going, guys. Like, if the age of the co-pilot is behind us, how are you replacing humans? This is your job in B2B software, is to genuinely replace humans. I'm not a Harvey expert, but I do believe Harvey is partially replacing associates, right? That's a lot of money there. Whatever Harvey is today, it's going to get better. I guarantee you it's a better piece of software next year than it is at 8 billion, right? And it will replace more mediocre associates that make terrible, that don't want to do it and want to go home at 4 p.m. and don't want to work on the IPO prospectus. It will just find that money, and you can grow 50% faster. Harry's with me on this.
I am, but the trend I'm finding across shows is that Jason is becoming more and more right with his assertions. Have you seen this? In the more recent episodes. Yeah, and you're agreeing more and more with him.
It's one comment here. I think the conviction that he brings from his use of the product is really valuable. I've a number of my colleagues who are engineers, and it's just really great when you can say, when you actually touch and use the product. If it's an app, I try and use it. If it's Cursor or something, my colleagues will be using it. I don't want opinions from people who just saw it on PowerPoint. When you use the product, it all becomes clear. And he's running a business where he's literally had people and now he has machines. That's what this is all about, right? And it doesn't mean that humans go away entirely. It means they find other uses. It means they find other roles. But when you see it happen, you believe. Because if you want to be a good investor, I have this concept. You can tell when people are saying something that they actually understand. It's a very good habit. And I'm listening to him, and sometimes on other shit, I'm like, Jason, you're just talking out your ass. I don't believe it. When he's talking about this shit, you can tell he has built these products. He has automated these processes. He's transitioned out those employees and he's getting a better product. And I'm like, yes, I don't know if I believe in all the claims for AI that the maximalists say, but I totally believe what there are areas where right here, right now, you can replace a $40,000 worker with a $10,000 a year agent and be better off. Right? And that's why it's not all just hype. I think the $1 million question is how fast that diffuses into the whole economy. But there are places here and now where you should just be using AI. And Jason is living that. He probably is right on the pointy edge. But he's right. If he's the most pointy edge Salesforce customer, in the next 2 years, they got to get 20% of their customer base plus maybe 30% onto being as pointy edge as Jason in terms of automation. Otherwise, these guys are going to go somewhere else to get their automation. And that's what it's going to take.
This is what I've learned. If they don't buy it from you and you have a market position, they're going to buy it from somebody else. right? And that's why I think Agentforce is so important, because, we have this thing on SaaStr, SaaStr.ai.agents, where we share all the agents we use. It came out of nowhere. It now gets like 12,000 views a month, okay, out of nowhere. It's not even highlighted. So that's a lot of traction. But we have tracked it. We've sent millions in revenue to 2 vendors, Artisan and Qualified, that we use because we use them. Millions in a couple of months of deals. And we send it to Agentforce now too, that we use it. If other folks are building these agents and you're not building them, or they're not on your platform, they're going to find them somewhere else. The demand in some of these categories is insatiable. Like vendors, if you really can replace humans with software for real, not for pretend, not for San Francisco, but for real, and you have even a mini brand, you will find you have more demand today than you can actually service. You can't even onboard the number of customers that want to replace their sales team with an AI. Now there were there's the X11s and the blow-ups of last year, but Harry can talk to us about that. But the demand is like something we've never seen. It's insatiable to replace humans with software.
I saw, it's kind of tied to this, but it was talking about, I'm trying to find it, but it was speaking about the adoption of open evidence. I think, open evidence grew to 300,000 doctors in 1 year, which is 1/10 of the amount of time it took Doximity. Thought that was interesting, just in terms of like market pull and adoption rate, going to what we said last week, which was just everyone being in market at the same time.
It is super interesting, right? You're exactly right. And the fascinating thing is that open evidence got there in a year, what took Doximity 10 years. And it speaks to, yes, this latent demand for kind of AI. You just got to put the negative in, the gnawing worry, which is, you just got to say the following fact, though. There aren't any more doctors as a result. And this is something Jason said last time. Everyone's in the market right now. You could have a world whereby you get every doctor on the platform in 3 years and have you saturated TAM more quickly, right? And that's why one of the things when you look at these hyper growth rates, and they're so compelling, and I think you just got to say to yourself, you've got to be sure that once you get all the names, that you have enough follow-on stories for those names. You don't want to be one and done, right? Because Doximity is a really good company. It has a finite TAM associated with the numbers of doctors and the amount of advertising and kind of stuff you can sell to them. Open evidence plays in roughly the same market, right? Probably at its current privately held valuation, it will need to expand that market substantively to offer a return from here. Totally doable, but it's not just going to be, getting there quickly and then stopping. Does that make sense?
Totally makes sense.
Because, as I said, TAM count, and one of the things we started to do is for all these tools, you should know for each of the tools, professional tools, how many of that profession exist. How many lawyers, how many doctors, how many bankers, how many wealth advisors, because that's your tie, right? And tracking that, and then it's really number of people times the amount of their work you can automate. Because in the end, these are finite money piles. But great adoption. It does speak, and what it means is that sounds a little more negative, but let's put the positive out there. Open evidence sees the moment. And if you come along, to Jason's point, a year from now with a slightly better version of open evidence, to a rounding error, no one will care. Because you missed the moment when 90% of the people who are ever going to adopt a tool like this are probably in market now in the last 2 and the next 1 year. They're all going to make their initial decision pretty damn quickly. You've shot up the S-curve super fast. And if you've missed your moment, you've missed your moment.
Yep. Having said that, just going to Mark Benioff's point, which I think was a good one from before when he was on the show, there are categories where you'll miss your moment, right? For sure. If you are a little slow, maybe find the areas that are slower. Mark's point was like only a couple % of his customer base is fully ready for AI today, right? So if you are a little, maybe play to your strengths. If you're a little slow, maybe go into retail or manufacturing or areas. It's not that the AI isn't there, but it hasn't changed overnight, right? Play to your strengths.
I agree, Jason. And it's interesting because open evidence, just like ChatGPT, is an individual adoption product. I think the velocity of individual adoption, you see it in Lovable, is explosive. The adoption of corporate adoption, the pace of corporate adoption is much slower. So you're exactly right. I don't think everyone's going to buy Agentforce or their equivalent in a year. It might be 5 years, not 10, like SaaS. It might be half the time of SaaS, but it still could be 5 or 6 years. I think the fascinating thing is the consumer has shown they're going to adopt in a year, right? And that's what you saw with the open evidence. It was interesting. If you looked at some of the general AI search and AI science tools, the number one user was doctors using general research tools to look up very specific medical questions, presumably meeting some patient with an odd disease. And open evidence caters directly for that need. It was a perfect product, and the adoption's been enormous and super quick. And I think that's what you're seeing in all the individual users. Like, we can talk about the pace of adoption in corporate law of people like Harvey, but I can tell you every individual associate is legally or illegally using ChatGPT to help them format their masses of writing. And when you do any kind of market research, you confirm that. Even if, they don't have a corporate use case, they just have their laptop open and are cranking along.
Okay, fantastic. It has never been harder to do Series A investing than today. Agree or disagree?
I'll tell you why I disagree. Ignore some of the stress around price and otherwise. This is the best of times to be a Series A investor because there is just an explosion of seed AI startups. There's so many, and they can't all get funded. And I know it's stressful. I know it's hard. But it is a gift that thousands of founders are in San Francisco raising seed funds from multiple accelerators now, YC, Neo, South Park Commons. All these folks are creating very smart, good candidates that, it's hard and you got to hunt and it's competitive, but the funnel is better. The top of funnel is the best it's ever been. So even if it is hard, this should be the best of times to be Series A because the funnel's the best. The one layer up on your funnel is the best. And I think it's the worst for seed because everyone each year wants to be a seed investor even more. Everyone, Jake Paul, Jake Logan, whatever, which of the Jakes, it's not just the chain smokers anymore and Jared Leto. It's everybody is playing at the hot seed startup level.
Sasquatch footballer.
Yeah. Everyone's in. So it should be a gift to be an A. It should be the best stage, stressors and price aside.
And I think the stresses and the price are the issue. But yes, I actually do agree. Yes, there's a lot of things. And the other thing that's actually helpful is the direction of travel is now clear, right? If you think back in that last couple of years before ChatGPT, we were at the end of the SaaS era. It wasn't obvious what was going on. A lot of the deals you did then turned out to be evolutionary dead ends. I do at least feel now, since ChatGPT, that the direction of architectural direction in enterprise B2B for the next 10 years is pretty much obvious and a given. It's some form of agentic software. I hate that word. It conveys a lot, but some form of re-architecting the enterprise stack to enable AI to do more of the work. That's the mission. The task has been assigned. And the only question now is which verticals first, which tasks first, who will be an early adopter, who will be late. So the direction of travel is pretty clear. That's the good news. But unfortunately, I think the bad news is there's just a lot of capital doing it. And, we're finding from just a raw competition and need of speed execution, it's a lot. But that's life. It should never be easy to make a lot of money.
The most recent person I lost to was Andreessen Horowitz. Who was the most recent person you lost to?
I would say earlier on this year, very talented senior investor, Atlanta Perkins. Great name, can't argue with it, right? So yeah, and I think the relevant point there is I would have maybe expand on that versus just having it be a litany of shame. 5 years ago, I would have said those guys would be slightly early. Some firms would be earlier, and we'd run into a slightly different peer set. But what's happened now is, we typically do in revenue A's and B's, so it's kind of early product market fit on. Given the fund size, all the large firms that were, typically seed and A are doing all those deals. So the competition set has stiffened, right? You're up against tougher, better firms, and you've got to bring up your A game, right? There's no doubt. If I was to list things that worry me, it would be that. And in the face of that, you've got to do all the things you got to do. You got to work on your relationships with the entrepreneur earlier. You've got to see the deal earlier. You've got to be more decisive. You've got to play to win when you want it, which means you got to know what you want to win. So I shared with my LPs that I would say that the talent of the people we are competing against has gone up markedly. And the good news about this is, we're fishing in the same ponds as some of the smartest investors on the planet. And the bad news is you're competing against some of the best investors on the planet. And you just got to find a way to win.
Nice, man. Final one. I would rather be in Kalshi at $5 billion than Polymarket at $9 billion. Agree or disagree?
I actually think my comment would be this. I wish I wasn't one of them. And I don't mean that just glibly because they're good, right? It's typically consumers, not our focus, but I really like that space. I really like the idea of prediction markets. I think it's a very clever and good idea. I think there's going to be a lot of issues around the sporting. I mean, there's the sporting gambling side of that. You can get trouble by that. I know in the States we can be. Coming from Europe, we bet on sports all the time. As Paddy Power is an Irish company. There's a lot of great sports betting goes on. I do think the fascinating thing about Kalshi and Poly is the whole Brian Armstrong thing about you have these prediction markets and then the person can put their finger on the scales of who wins. In this case, Brian Armstrong, by using a certain set of kind of phrases during his earnings call, basically dictated, I think it was a Kalshi bet one way or the other. There's going to be a lot of weird stuff that happens as a result of this, like some of these policy bets where you just know an insider is making a trade, 1 hour before the administration announced something, you see it hit on Kalshi and Polymarket. So there's a lot of fun stuff. But as a deal to be invested in, they would be fun. And at some level, that's worth having.
So Kalshi.
Why? I mean, as I'm a customer, yes.
If it is accurate to say that Kalshi is fully U.S. compliant in all 50 states today, and Polymarket is still in an ambiguous position, even with NASDAQ's investment or DICE investment, if that's true. I don't know if that's true.
I think it's changed now. I think it's under the current administration, pretty much everything is legal.
Yeah. So what I was going to say is politics aside, there is a chance there will be a new administration that will be less sympathetic to this category. So based on my limited knowledge, I'm going Kalshi because I feel like it is a safer long-term bet than someone that is riding the current political vibes, which are all in favor of everything here. It was a lot different a couple of years ago, and it could be a lot different in a couple of years to come. And so if I could slightly de-risk the regulatory side, because it's CFTC approved or DCM approved, I would take that bet just because I don't know who the heck's going to be president next. I don't know. But the first act could be to undo everything that Sachs and buddies have done. That could be January 1st, whatever. But I mean, these edicts, it's all going. Crypto's out. Kalshi's out. Polymarket's out. Everything's out. Could be the next administration. It's all gone.
Just to make a prediction, which is in keeping with the idea here, I predict that any re-regulation won't happen because of any new administration. I think the real challenge to sports betting like this will actually be the leagues themselves wrestling with the fact that when you have sports betting, you have sports cheating. And if it becomes endemic, like some of the European soccer leagues, it'll be a problem. So I actually think a fun problem for the next baseball commissioner, basketball commissioner, NFL commissioner will be, what the hell do you do about this thing when you have these very particularized bets? Not will the Cowboys win by 7, but in the third quarter, will the quarterback throw a second throw that misses? The possibility for cheating just becomes high. So I actually think that problem, the next administration will have plenty of other things to deal with. That particular problem will be the purview of, as I say, the sports folks, is my gut.
I hope you Americans don't watch any Pakistani cricket then, because that would really show you the way to do it. But guys, this has been a joy.
No American spends a single second watching cricket. It's just torture. But we respect that you guys love it. Even though you're not good at it anymore.
Rory, do you know what, Rory? I would love to take you to Lord's. Come to London. We'll sit and watch a 5-day game. Yeah. And we'll watch every day. And then it's going to be a draw at the end.
No, absolutely. Yes. A product that was not built by them. The one thing you know about cricket, it was not designed by an American TV executive.
Hopefully mobile phones are collected outdoors too. That's my hope. You have to put it in a basket so that nobody could be on their phones.
Silence in the stadium. Yeah.